Stop what you're doing. If you own the Hartford or really any financial stock for that matter, you need to hear this deep fundamental breakdown. Last week, I ran the Hartford's massive Q1 2026 earnings release through a rigorous 5-model valuation breakdown, along with Warren Buffett and Peter Lynch's classic investment checklists. And honestly, what I found completely shocked me. I mean, what if I told you that a seemingly boring 200-year-old insurance company is secretly pulling off one of the most aggressive strategic pivots on Wall Street right now? We're talking about shedding nearly $2 billion in assets just to trim the fat. Now look, I know a super common pain point for retail investors is the absolute fear of getting caught holding the bag. Financial stocks can be terrifying, right? They're often loaded with hidden legacy liabilities, and frankly, analyzing them feels like staring into a black box of impossible math. But there's a very specific reason Warren Buffett absolutely loves a disciplined insurance company. When it's run correctly, it is the ultimate cash flow engine. It's literally a financial fortress. So the bold rhetorical question we have to ask ourselves today is this. Is this new, leaner, meaner version of the Hartford a brilliant Buffett-style buy? Or is it a classic Peter Lynch value trap just waiting to quietly crush your portfolio? Well, by the end of this explainer, you'll know exactly if this stock is a Buffett buy or a Lynch trap. We're going to figure out exactly how to value this radical transformation, and I promise to give you a clear, actionable framework that you can steal to analyze their actual underwriting health from here on out. So let's dive right in and unpack this massive Q1 transformation. Okay. Let's start with a surprising number that should make absolutely any fundamental value investor sit up straight. In Q1 2026, the Hartford reported a staggering $851 million in net income available to common stockholders. Guys, that is a massive 36% jump compared to the previous year. To put that into perspective, this stock's intrinsic value could be radically shifting right before our eyes because that kind of bottom line explosion, it doesn't just happen by accident. It's the result of a highly tuned financial machine, and it definitely demands our full attention. Section 1, Q1 2026 Earnings Breakthrough. You know, to truly understand where a company is going, we have to look at where it's been. This isn't just a one-off lucky quarter. Notice the steady upward trajectory in net income. We're going from $2.48 billion in 2023 straight up to over $4 billion for the trailing 12 months ending in Q1 2026. This completely validates CEO Christopher Swift's claims of consistent, durable performance. They aren't just having a good quarter. They're stacking consecutive years of compounding growth like building blocks. But here is the truly fascinating metric, a 23% trailing 12-month net income return on equity. Now, return on equity, or ROE, is basically the ultimate measure of how effectively a company is using your shareholder money to generate profit. Hitting 23% proves their core engine is ridiculously efficient. They are absolutely firing on all cylinders when it comes to maximizing the capital they've got. Moving on to Section 2, Segment Breakdown, Underwriting Discipline. So how exactly are they achieving this? Let's open up the hood and look at the tale of two massive divisions. On one side, we have the heavy-duty engine of business insurance. They actually grew their written premiums by 6% to $3.9 billion in the quarter, operating at a 94.8 combined ratio. On the flip side, personal insurance tightened up significantly, pulling in an impressive 87.7 combined ratio. Both are performing incredibly well, but they serve totally different functions in the overall portfolio. Quick time out for a second, just to make sure we're all on the exact same page. The combined ratio is the lifeblood metric for any insurance company. It simply measures incurred losses and expenses against earned premiums. So the absolutely crucial thing to remember is that any number below 100 means the company is making an underwriting profit before they even touch their investment income. Seeing the Hartford clock in at 94.8 and 87.7 in their key segments, that reflects a phenomenal level of underwriting discipline. They are writing highly profitable business.
All right, Section 3, the $1.9 billion strategic pivot.
Now, the real climax of this quarter wasn't just the underwriting. This quote from CEO Christopher Swift regarding the sale of Hartford Funds to Wellington Management is incredibly telling. He frames this not as losing a division, but as a very deliberate strategic pivot. They are actively choosing to shed their fund management arm so they can double down on pure, unadulterated underwriting. It's a classic Wall Street power move. Trim the fat and focus strictly on your core competency. Let's break down the actual financial terms of this massive deal, which is expected to close in Q1 2027. It carries a net present value of roughly $1.9 billion. The Hartford gets $300 million in cold hard cash right up front at closing. But honestly, the real genius here is the 7-year earnout structure. They're going to continue receiving payments based on the future cash generated by the business over the next 7 years. So they're shedding the operational weight, but keeping a long-term profit pipeline firmly attached to Wellington's performance. And hey, while they wait for that deal to close, their existing investments are doing some serious heavy lifting. They're sitting on a highly diversified $63.7 billion investment portfolio. Because they position themselves so well across taxable, fixed maturities, U.S. Treasuries, and alternative investments, they've been able to reinvest at higher interest rates. This boosted their Q1 net investment income to a whopping $739 million. Which brings us to Section 4, Navigating Catastrophes and Liabilities. Now, a true fundamental analysis means we have to objectively look at the pain points right alongside the wins. First, the good news. Current accident year catastrophe losses, or CATs, were basically cut in half. They dropped from $467 million down to $230 million year over year. But here's the sting. That benefit was partially offset by a $70 million reserve set aside to cover legacy general liability claims. Specifically, these are related to historical sexual molestation and abuse cases tied to policies from way back in the 1970s and 1980s. While these cases obviously carry a tragic and profound human cost, from a pure financial analysis standpoint, we have to look objectively at how this impacts the company's liabilities today. So the crucial takeaway here is understanding a term called PYD, or Prior Accident Year Development. Basically, insurance companies constantly have to adjust their reserves based on new information about very old claims. This $70 million hit perfectly illustrates how historical legacy liabilities from literally decades ago can suddenly pop up out of nowhere and impact a modern earnings report today. It's exactly the kind of risk that makes a lot of retail investors really nervous. Section 5, Wall Street's Final Verdict. So taking all of this in, the massive income jump, the brilliant combined ratios, the $1.9 billion pivot, and of course, those legacy liabilities. If we walk through the timeline of recent analyst ratings, it's honestly a bit of a mixed bag. We saw Citigroup bump their target up to 143 back in February. Then, after the earnings release in April, UBS slightly lowered their target to 155. And most recently, in June, Keefe, Bruyette, and Woods cut their target to 142 following the news of the fund sale. The analysts are clearly out there recalculating their models in real time. When you aggregate it all together, MarketBeat shows that Wall Street is maintaining an overall moderate buy consensus with an average target price hovering right around $148.88. It's pretty fascinating, right? Despite a staggering 36% jump in net income and a massive 23% ROE, Wall Street is still playing it somewhat cautious. They like the stock, sure, but they definitely aren't completely letting off the brakes just yet. Which leaves us with the ultimate question. Is the market wildly underpricing this transformation? Will shedding a $2 billion fund management arm to double down on pure, disciplined underwriting be the catalyst that finally breaks the Hartford out of Wall Street's super conservative valuation models? Is this leaner, more focused company the ultimate fundamental buy? Well, I'll let you look at the numbers and decide that for yourself. Thanks so much for joining me on this explainer, and hey, whatever you do, keep your eyes on those combined ratios.